price you're staring at is lying, and the spread is telling the truth. And the people who live in the physical market can feel it in their bones. Because while the screen flashes fear and the headlines scream top, something uglier and more important is happening underneath. Forced selling is exhausting itself, real-world demand is quietly stepping in on weakness, and the calendar is setting a trap for anyone still trading metals like they'd just another ticker. Stay with me, because later in this video, I'm going to give you the exact checklist for the next 1 to 2 weeks. What level matters, what confirms the thesis, what breaks it, and the one underwatch signal that usually shows up before the big move becomes obvious to everyone else. Right now, gold is hovering in the low 4,000s, and silver is holding in the low 70s after a brutally emotional year-end whip that shook out anyone who thought metals only go up in a straight line. And if you felt that whipsaw, you're not alone. That end-of-year surge and snapback wasn't just sentiment, it was structure, it was leverage meeting reality. It was a market that got crowded, got expensive to hold, and then got forced to puke positions when the rulebook changed. And that's where the real pressure starts, because the crowd always reads those cascades as the trend is over, when in metals, cascades are often the market clearing its throat before it speaks louder. Now, I know the title sounds like pure fantasy, $8,000 gold and $200 silver. Those numbers trigger the same reflex in smart skeptics every time. Eye roll, dismissal, clickbait. Good, keep that reflex, it's protective. But here's the twist. You do not have to believe those targets to understand why the path toward them exists, and why the next phase can be violent even if it's not immediate. Because the bull case for metals isn't emotion, it's math. It's supply chains that can't scale on demand. It's collateral systems that get stressed. It's currency confidence that doesn't collapse all at once. It frays, then it snaps in pockets. And in a leveraged market, pockets are enough to move the whole complex. But that's not the part that matters. What matters is how we can tell, this week, not someday, whether the market is building a base for continuation or setting up for a deeper shakeout. Let's start with the street symptom, because it's the easiest thing to miss if you only stare at charts. When gold and silver pulled back, the physical market didn't die. In a lot of places, it woke up. Premiums, the real-world extra sub people pay over benchmark to get metal in hand, tend to do something very telling during corrections. When panic hits paper, premiums often rise, or at least refuse to collapse, because the buyers who actually need metal don't care about your candle pattern. They care about availability, lead times, and replacement cost. They care about getting the thing, not winning the debate on social media. And when you see that dynamic, paper selling hard while physical demand firms, that hence the market telling you the correction is mostly about leverage, not about the underlying need for metal. And that's where the real pressure starts, because leverage can unwind quickly, but physical tightness doesn't heal quickly. It heals on production timelines. It heals on logistics. It heals on policy. And those don't move at the speed of a margin call. Here's the hidden detail that reframes the entire story, the premium flip. When prices are rising, everyone thinks demand is strong because price is up. That's lazy. The more honest test is what happens when the price drops. Do real buyers step away and wait for lower? Or do they step in and treat the dip like an opportunity to secure supply? That single behavior, buyers showing up on weakness, tells you whether you hold in a speculative blow-off or in a structurally bid market that S being temporarily distorted by paper flows. And if you've watched metals long enough, you know the most explosive runs often begin when the market looks broken on the screen but feels tight in the real world. Because price discovery in metals isn't pure. It's a negotiation between futures, inventories, financing, and physical procurement. And when those disagree, the disagreement is the trade. Now, let ES talk about the force that tries to suppress or deny the move, not in some cartoon conspiracy way, but in the way incentives work. Large participants, dealers, and institutions manage risk through the paper market. They hedge. They warehouse exposure. They use futures to smooth volatility. And when volatility spikes, their first job is not to let price run. Their job is to survive. That means tightening risk, reducing exposure, and, most importantly, demanding more collateral. That's why in moments of rapid upside in metals, you'll often see margin requirements rise. That's not a moral judgment. It's a mechanical response to volatility. But it creates a brutal side effect. It forces selling and liquidation, regardless of the fundamental story. And that's the trap. Because if you don't understand the margin mechanism, you'll interpret forced liquidation as smart money dumping. In reality, it's often the most levered positions getting taken out behind the barn. So here's the mechanism, clean and simple. Futures are leveraged instruments. You don't pay full price for the contract. You post margin, a performance bond. When volatility increases, exchanges and brokers can raise the margin required to hold that position. If you're levered and the margin requirement jumps, you either post more cash or you reduce exposure. That reduction often means selling contracts into a falling market. That selling pushes price lower, lower price increases stress. Stress triggers more risk controls. Risk controls trigger more selling. It's a spiral. And spirals don't care about your long-term thesis. They care about today's cash. That's why metals can drop hard, even if the long-term story is intact. And that is why the most important question right now is, Otini, are gold and silver bullish long-term? The question is, has the forced selling cycle reached exhaustion? And is the market transitioning from a liquidation regime back to a demand-led regime? You can actually see this transition if you know where to look. Not just in spot price, in spreads, in the relationship between the near month and later months, in the cost of carry, in the little micro signals that tell you whether someone is desperate to sell now or desperate to secure now. Because in commodities, now has a price. If the market is loose, the future is priced higher than the present contango, reflecting storage, insurance, financing. If the market is tight, the present can trade at a premium to the future, backwardation, reflecting scarcity and urgency. Metals don't live in permanent backwardation the way some consumable commodities might. But when stress hits, the nearby structure and the lease financing dynamics can start to act funny. And funny is information. It's the market confessing. But that's not the part that matters yet. The part that matters is how this ties directly to that 8,200 narrative without turning into hype. Those targets become plausible, not because someone predicts them on a chart, but because metals are a pressure gauge for the system that prices everything else. If confidence in collateral weakens, if real yields swing, if currency stress spreads, if central banks keep diversifying reserves, if industrial demand for silver stays sticky while supply is constrained, then the market doesn't T-move in a polite linear way. It moves in lurches, it gaps, it overshoots. And the lurches are usually triggered by calendar windows where liquidity is thin and positioning is wrong. Which brings us to the why now catalyst, the calendar. Early January is a weird time. Liquidity can be thinner than people realize. New year positioning happens. Funds rebalance. Risk managers reset limits. Some players come back from the holidays and find their books Dawn T look like the market they left. Delivery cycles keep marching regardless of your vacation. And if volatility was high into year end, the risk systems are already alert. The market doesn't need a dramatic headline to move. It needs one pocket of forced activity, meeting one pocket of thin liquidity. And then the dominoes start. And that's where the real pressure starts, because when liquidity thins, small flows move price more than they should, which then triggers the narratives, which then triggers the emotional trades, which then feeds the reflexivity. Now, let's address the elephant in the room. Paper versus physical. People love to turn this into a simplistic fight. Paper is fake. Physical is real. That's a slogan, not a strategy. The more useful reality is this. Paper is where price discovery happens quickly, and physical is where constraints reveal themselves slowly. Futures markets are designed to transfer risk. They can carry enormous notional exposure relative to physical stocks because most contracts are rolled or closed out, not delivered. That's not fraud. That's how hedging markets function. But it does mean that in moments of stress, the paper market can overshoot both up and down because it's absorbing leverage and fear and hedging flows. Physical tightness acts like a floor, but it's a soft floor until it isn't. And when physical tightness becomes an urgent floor, when premiums jump, when availability worsens, when the nearby structure tightens, that's when the paper market is forced to reconcile with reality. Not because someone is manipulating it, but because arbitrage and delivery incentives start to bite. Here's how that bite works. If physical is tight, refiners and fabricators may pay up to secure feedstock. Dealers may raise premiums. In some regions, import demand may increase. If those premiums stay elevated, they can justify moving metal from one place to another. That movement isn't instant. It's shipping, financing, insurance, paperwork, sometimes policy constraints. But the point is, sustained premiums attract supply the way high rent attracts new construction. Slowly, and only if the economics work. And if the economics don't work because supply is constrained or policy interferes, then the pressure doesn't dissipate. It builds. That's why the premium flip is the hidden detail. It tells you whether the dip is being absorbed by real demand, which is the seed of the next squeeze. Now let's talk inventories, because this is where most commentary turns into noise. You'll hear people say, inventories are down and jump straight to apocalypse, or inventories are fine and dismiss everything. Both can be wrong at the same time. In the warehouse system that supports exchange delivery, not all inventory is created equal. Some is deliverable against contracts, registered, and some is simply stored and meets specifications but isn't committed to delivery, eligible. Eligible can become registered if the owner chooses and if it makes economic sense. Registered can become eligible if the owner chooses. The line moves based on incentives. That's why screaming registered as low without discussing incentives is incomplete. The better question is, under what conditions would owners of eligible stock be willing to make it deliverable? What premium would they require? What financing cost? What risk? And what happens if that premium rises while paper is still priced as if supply is comfortable? That's where spreads and premiums start screaming. And here is the practical takeaway. Inventories don't have to go to zero for price to jump. They just have to get tight enough in the deliverable category that the nearby market gets nervous. Nervousness shows up in the structure. It shows up in lease rates and borrowing conditions. It shows up in the behavior of dealers and fabricators. It shows up when retail availability stays firm even during a paper sell-off. It shows up when the dip doesn't bring the usual flood of cheap metal offers, but instead brings back orders and longer lead times. That's the on-the-ground symptom layer. And it matters this week because that S, how you separate a liquidation dip from a regime shift. Now, silver deserves its own spotlight because silver is where the story can go from steady to violent faster than most people expect. Silver is both a monetary metal and an industrial input. That dual identity is a blessing and a curse. It means silver can lag when fear is low and then explode when industrial procurement collides with investor demand. And silver supply is stubborn. A big portion of silver supply is a byproduct of other mining. Lead, zinc, copper. You don't just turn on silver supply because silver price rose. You need primary projects, capital permitting, time. Recycling helps, but is also price and logistics dependent. So silver can get into these situations where demand shifts quickly, but supply responds slowly. That mismatch is the raw material of squeezes. And the market structure of silver, thinner, more volatile, more easily pushed by positioning, makes the moves sharper. Add a policy into that mix and things get even more interesting. When a major producer or refiner country changes export rules, licensing, or controls around certain metals or metal products, it can create uncertainty and delays even if the total supply doesn't disappear overnight. Markets don't need actual shortages to spike. They need the perception of procurement risk. If buyers fear that supply will be harder to secure, they pull demand forward. They stockpile, they overorder, they lock in. That behavior alone can tighten the market and lift premiums. And that's where the real pressure starts, because procurement is not like investing. A factory can't wait for the RSI to cool off. If silver is a critical input and your lead time is uncertain, you buy. You pay up, and you push the problem down the line. Now, let's stack the proof, because you should never rely on one argument in markets. Proof point 1, the violent year-end move and snapback itself, which is classic margin and positioning behavior, not a slow fundamental repricing. Proof point 2, the physical demand response on dips, visible through premiums and on-the-ground buying behavior in major physical markets. Proof point 3, the term structure and spread behavior, whether the nearby tightens relative to the back months, whether carry conditions shift, whether the market starts pricing urgency. Proof point 4, inventory nuance, deliverable versus non-deliverable stock, and the incentive to convert, plus any signs that deliverable tightness is becoming a constraint. Proof point 5, institutional demand, central bank accumulation as a slow baseline bid, and ETF ETP flows as the accelerant that can turn a grind into a surge. Proof point 6, the wild card, policy and supply chain friction in silver, where even small changes in export, refining, or logistics can change the availability narrative fast. None of these alone guarantees anything, but together they create a setup where upside can be asymmetric if the liquidation phase is ending. But let's be honest and credible. There are real counterpoints, and ignoring them is how people get wrecked. First, metals can fall even when the thesis is right, because short-term pricing is a function of liquidity, rates, and leverage. If real yields rise sharply, if the dollar strengthens, if risk assets puke and the market scrambles for cash, gold and silver can get hit in the crossfire. That's not gold failed. That's the collateral system doing what it does under stress. Second, high prices can temporarily kill certain segments of demand. Jewelry demand can slow. Some industrial users can attempt substitution or efficiency. Third, if supply does show up, scrap flows, inventory releases, increased hedging, tightness can ease. Fourth, policy can surprise in either direction. And fifth, sentiment can overshoot. When everyone is all in on the same story, even a bullish story, the market can punish that crowd first. So the goal isn't to predict a straight line to 8,200. The goal is to trade and invest like an adult, identify the regime, identify the catalysts, respect volatility, and know what invalidates your thesis. Because here, that's the hard truth, the market's favorite trick is to make you emotionally sell the asset right after it proves the thesis. It does it with headlines. It does it with sudden dumps. It does it by making you feel late, then making you feel stupid, then making you feel desperate. That's the volatility script. And if you don't recognize it, you will become liquidity for someone else. So let's translate the mechanics into what it forces participants to do. If margin requirements rise or brokers tighten risk, levered longs must reduce. That creates down pressure. If that down pressure hits key technical zones, systematic funds may sell. That adds fuel. If liquidity is thin, price moves more than expected. That triggers more stops. That's the flush. But once the flush has done its job, once the weakest hands are out and the forced sellers are done, the market often snaps back because the underlying demand never left. And that's where the real pressure starts. Because the people who sold under pressure now have to decide, do they re-enter higher or do they miss the move? Meanwhile, the buyers who are waiting for confirmation get dragged into chasing. That's reflexivity. It's not magic. It's behavior under constraints. Now we move to the what comes next roadmap, and I'm going to frame it with a simple 2-scenario lens, because that's how you keep your head when the screen tries to steal it. Scenario 1 is the controlled pullback and retest. In this scenario, gold and silver retrace into obvious support zones, volatility cools slightly, and price holds above the levels that would imply the entire move was a blow-off. You might see a choppy base, you might see sharp intraday wicks, you might see sentiment sour. That's normal. What confirms this scenario is not a beautiful pattern. It's behavior. Dips get bought, premiums stay firm, the market stops reacting as violently to bad headlines, and the spread stops screaming stress. In this scenario, the market reloads, it builds a platform, and then it pushes again, often when the crowd is bored and skeptical. And that's where the real pressure starts. Scenario 2 is the continuation, squeeze, and gap risk. In this scenario, the market doesn't give you the tidy retest. It keeps grinding higher, or it snaps higher after a brief dip, and it does it during a window when liquidity is thin. Early week opens, overnight sessions, around policy headlines, around delivery and roll dynamics. This scenario is nasty for people who want perfect entries because the price can gap. It can jump in a way that makes you feel like you missed it, and that emotional reaction is exactly what creates sloppy chases at the worst times. What confirms this scenario is acceleration. The market starts shrugging off selling attempts. Silver begins outperforming gold in bursts, and the narrative shifts from bubble to shortage to central banks all at once. In that environment, the biggest risk isn't T just being wrong, it's being right, but positioned in a way that volatility can destroy. Now, what would weaken or invalidate the bullish near-term thesis? If gold breaks below key prior support zones and can't reclaim them quickly while premiums soften and spreads relax, that's a sign the market is not under immediate physical stress, and the move may need more time to rebuild. If silver loses its bid and starts underperforming in a way that suggests industrial demand is backing off sharply, that matters. If the macro backdrop shifts, real yields ripping higher, the dollar surging, liquidity tightening, metals can stall or drop. And if you see evidence that inventories are being replenished in the deliverable channels, or that supply is flowing freely without premium tension, the urgent tightness narrative weakens. Notice what I'm doing. I'm not giving you a prophecy, I'm giving you a dashboard. Because in markets, the dashboard is everything. So here S the concrete checklist for the next 1 to 2 weeks, the payoff I promised, without the fluff. First, watch physical premiums and availability behavior on dips. Not because premiums are perfect, but because they are one of the few windows into the real market S willingness to pay right now. If price drops and premiums stay firm, that's a constructive sign. Second, watch the structure, nearby versus deferred contracts. You're looking for signs of urgency, signs that now is being valued more than later, or at least that the structure is refusing to relax even when price wobbles. Third, pay attention to any margin or risk control changes and how the market responds. If the market absorbs them and stabilizes, that suggests forced selling is burning out. If each risk tightening triggers another cascade, the liquidation phase isn't done. Fourth, keep an eye on inventory narratives, but read them with nuance. Deliverable versus non-deliverable matters. Incentives matter. Fifth, watch silver's behavior relative to gold. Silver leading in bursts often signals risk on demand and squeeze potential in the metals complex. Silver lagging can signal caution. Sixth, watch the calendar. Thin liquidity windows, delivery and roll periods, and any policy deadlines that could change procurement behavior. Those are your catalysts, not the drama of the day. Now let's talk psychology, because even if you're right about everything I just said, you can still lose if you let volatility weaponize your emotions. The market will try to pull you into a loop. It will pump, making you feel late, then it will dump, making you feel stupid, then it will rally, making you feel desperate, then it will chop, making you feel exhausted. That cycle is designed to turn your attention into liquidity. The antidote is a simple distinction, trend signal versus noise. Trend signal is the market holding key zones, absorbing selling, maintaining the structural tells, premiums, spreads, resilient demand. Noise is the daily headline whiplash and the intraday spikes that exist to trigger reflexes. The moment you confuse noise for signal, you start making decisions that aren't yours. They're borrowed from the crowd. And this is where skepticism becomes your superpower. You don't have to buy the 8,200 narrative to act intelligently. You just need to understand the mechanisms that can create upside asymmetry, a market with constrained supply response, fragile liquidity, and a habit of compressing stress until it releases. That release can be slow, then sudden. It can be a grind that feels boring, then a week that feels unreal. And if you want to be on the right side of that kind of move, your job is not to guess the top or bottom. Your job is to recognize the regime change as it happens and manage risk like a professional. So where do those big numbers fit then? Think of them as scenario endpoints, not promises. If the world stays in a regime where central banks continue diversifying reserves, where currency confidence keeps fraying, where geopolitical and trade stress keeps pushing countries toward hard asset behavior, and where industrial demand for silver keeps colliding with a stubborn supply response, then the tail risk upside in metals is not a joke. It's a logical outcome of stress compounding in a leveraged system. 8,000 gold isn't tomorrow. 200 silver isn't next week. But the market doesn't need to reach those numbers for you to benefit from understanding the path. Because most of the real opportunity is in the transition from disbelief to acceptance. That transition is where flows accelerate, where hedges become chases, where people who mocked the move are forced to respect it. And that's where the real pressure starts. One more thing before we close, because this is the part viewers always want but rarely get. What do you do with uncertainty? You stop outsourcing your conviction to the loudest voice. You build a rule set. If the market holds key zones and the structural tells stay firm, you stay patient through noise. If the market breaks those zones and the tells soften, you reduce risk. If volatility spikes, you remember that price can whip around violently even if the thesis is correct, and you size accordingly so you're not forced to act at the worst time. That's how you stop becoming a pawn in the volatility game. And if you've made it this far, you already know what kind of investor you are. You're not here for comfort. You're here for mechanism first clarity. You're here because you've watched institutions frame the narrative after the move, not before it. You're here because you'd rather be early with logic than late with consensus. So here's the subtle ask, not a beg, a filter. If you want more breakdowns like this, the kind that focus on structure incentives and what to watch next instead of vibes, stay close to this channel and keep your attention on the tells that matter. Because the next 2 weeks are not about arguing whether gold and silver should go up. They're about watching whether the market is transitioning from forced selling to forced buying. And if that transition completes, the crowd won't see it in a headline first. They'll see it when the price gaps and the excuses start. Watch the premium behavior on dips. Watch the structure for urgency. Watch silver's relative strength for squeeze risk. Respect the calendar. And above all, respect volatility, because it will try to trick you out of the best part of the move.